Hey guys, welcome to my channel. And in this video, I'm going to show you how to determine if you meet the income requirements to get a USDA loan. My name is Sam. I'm your mortgage loan officer. I help you finance your real estate transactions, and I educate you along the way so that you understand the mortgage process. So for USDA loans, I did a couple of videos. If you check in the description, I put links to the previous videos. Now we're going to look at how to determine if you're income eligible, because USDA does have an income eligibility requirement. And it's important because these loans were constructed in a way to help low to moderate income borrowers. So if you check on the link in the description, I have a link to this page here. And if you just click on income eligibility, you're going to pick the state below. So we're going to look in Georgia for this one, for this particular example. And it's going to tell you the state, and then you're going to pick the county. And Villa Rica is in Carroll County, so we're going to select Carroll County. And now it's going to ask you some questions here. So I'm going to just move myself over here. So it's going to ask you some questions here. How many people are in your household? So with USDA, they want to know how many people are in your household and what are their incomes. Now, those people that you add onto this list here, they may not necessarily be on the loan itself, but because it's income driven, USDA needs to know how much the whole household combined is making. Because again, like I said, this loan is for low to moderate income borrowers. So let's just say we have two people in the house, a couple, and we got one full-time student, a kid in college, and is the loan applicant or co-applicant age 62 or older? Let's say no, they're not. And are there any disabled persons living in the household? We'll say no. So we'll click on to next. So here we have state of Georgia, Carroll County, metropolitan area, and it just gives you some information here. So annual child care expenses. So let's just say this kid is 19 years old. He's in college. He's not working. He's probably not even in the house most of the time. So we're going to say childcare expenses are zero, but we know we're selling him, $100 here, a couple dollars here because he wants to, go to get some fast food. So we'll say base employment income. We'll say monthly income is $5,000. So this is monthly. So make sure when you enter this in, you're not putting in a yearly amount, you're putting in a monthly amount. So it's monthly income. Overtime, let's just say we're healthcare workers. So healthcare workers, they always put in overtime. So let's just say we're putting in about $1,000 extra a month. No bonus income, no commission income, no self-employment income, dividend interest income, nothing, net rental income. So you don't have any rental properties that you're getting cash flow from. And any other income, we'll put zero. All other income received by adult members of the household. If you have other adults living in the house, this is where you would add their income. So I'm going to click on this because this is very important. So eligibility for rural development loans is based on all household income. In some instances, there may be income in the household from an adult family member who is not applying for the proposed loan. So the income from all adult members of the household, even though they may not be a party to the loan transaction, must be disclosed for eligibility purposes. So even though they're not going to be on the loan, you have to include their income because it's an eligibility based loan. So the income needs to be verified and dependable. It should meet the same criteria as listed above in order to be considered. So make sure anyone that's in the house, so if it's a couple, we'll just say that this is the couple that has the strongest income, and the other income, let's just say they're not making as much. Let's say they're making $2,500 a month. So we have husband or wife, and here it could be husband or wife. The kid is in college, so they're not making anything. This is the overtime income, and then everything else is zero. So just make sure you fill this out as accurately as possible. And then you click finished. Now, the website will tell you if you meet the income requirements. And you can see here, applicant meets the income limits for Section 502 Guaranteed Rural Housing Loan program based on income entered on program income guidelines. So even though This is a good indicator to determine if you're income eligible. As a loan officer, I'm also going to check as well to make sure that you're income eligible, because I'm going to look at everything and verify everything as well. But this is just a good litmus test to see right away or quickly if you're eligible for a USDA loan. So here you can see it gives you a summary of the adjusted household income. So household income, so those two combined incomes that we put in for husband and wife was $102,000, and then it deducted the overtime income, and it adjusted the annual income, which came out to $101,520. So for Carroll County, which is the county that we're looking to purchase this home in, the maximum adjusted household income can be $123,650. So if we made over $123,650, we wouldn't be eligible for a USDA loan. If you have members in your household that have totaled this amount or greater, you would not be eligible for a USDA loan. So to meet the income requirement in Carroll County, Georgia, you would have to be under this number here. And here, the Section 502 Direct Rural Housing Loan Program. So these are for your low income borrowers. You would have to be under $86,000 to qualify for the Rural Housing Loan Program. And you can see with the adjusted household income, it exceeds that amount by $15,000. So we wouldn't be eligible for the Direct Rural Housing Loan Program, but based on the income that we put in, we would be eligible for the Guaranteed Rural Housing Loan Program. So in a separate video, I'll tell you guys the difference between the two, but mostly Direct Rural Housing Loan is for lower income borrowers, and the Guaranteed Rural Housing is for moderate income borrowers. Now, the differences between the two programs is that the Direct Rural Housing Loan Program is a little bit stricter because it's for lower income borrowers. So they're typically going to get a lower interest rate. Credit requirements are a little bit stricter, and the housing eligibility requirement is a little bit stricter. And they will not have to pay mortgage insurance. But in another video, I'll break down the differences between the two in greater detail. So that's it for this video. Let me know if you have any questions. Please leave them in the comments. And don't forget to like and share this video if you like it and found it helpful. And if you have any questions, definitely reach out to me in the comments. And I'll see you guys on the next video.